Ira Epstein with your agriculture wrap-up for this Monday, the 7th of October, 2019. And we're getting on at 4:05 p.m. Central Daylight Time. And as you can see, a mixed day in the grains. Now, just ending before 4 p.m. Central Daylight Time, the president was holding one of his impromptu news conferences. He did talk about Chinese trade. He was talking about Syria at length. And I've just got to say, when I heard him say what he said, I didn't realize we had all of 50 troops in Syria, and that's what this big pullout is about. I'm lost. I don't know what more to say on that. 50 troops, and that's what this whole thing's about? A policing action set of troops? Okay. In any case, in the grain market, is the market looking forward to the WASDE report that comes out on Thursday? Remember, that's going to be our supply demand. And importantly to us all, where are we on yields? Now, today, of course, we get the crop conditions report, but that's not going to have the impact of Thursday, and that's what traders are going to look at. I was talking to our grain people today, asking them, you think the farmers were out in the fields trying to get an idea of yield? And they went, absolutely, especially in the corn market, because that's where the harvest is going on. Beans, they're still waiting a little bit. We'll see how this all plays out. As we come to the grain market, especially an area chart of closes, well, you can't argue that this market's gotten over the 18-week average of closes in red, and it's staying over it. Support's back at 882. Market's acting pretty good. We're getting some sideways action distribution, but let's not lose sight that we got up over 921 on Friday, and this market's holding practically all of the gains that it's made. It also has a pattern of, from the swing line, higher lows, higher highs. Now, the way that I teach swing lines, what you should do is take this name, move it up if you mark it off on your chart with that arrow. The software I have will do most of that for you, but you don't need the name there. You just need to know what you don't want to get under. And what you don't want to get under is 906 if you're going to keep going into the report, the pattern of higher highs, higher lows. In addition, what the market did is it got up and over the 200-day moving average of closes and held that. Now, we had a bullish crossover, and let's not lose sight of this. This market had that crossover on Wednesday. When you get a bullish crossover, it's not unusual for the market after that to try to make a new high. Instead, what the market did on Thursday is pull back, but on Friday it went for the new high of the move. And now what it seems to be doing is pulling back into this support zone. If the 908 gives ground, then you might pull back into this whole support area if some news were to come out bearish, I would imagine. In terms of resistance, you hit it. You hit it back here when you had your first hit of the upper Bollinger Band, and admittedly you got higher than this high, but you didn't hit that band again, and you're just backing off a little bit. The first hit of an upper Bollinger Band is often, the word is not always, often an area that you encounter some resistance in the market or some support when you come down to it. In terms of momentum, it's bullish. Why? What markets often do is they'll bounce around between the traditional numbers of 20 and 80 in the slow stochastic. When you take my charting course, you'll see a different set of numbers that I think are actually more updated and better than that. But in any case, they'll typically get oversold, overbought. Time to time, you get both the numbers that make up the slow stochastic, which are called a K and a D line, and they're the red and the blue. And the whole difference in the formula is one uses, because it's a daily chart, 3 days worth of data, the other uses 5. That's it. So the red line's job is to whip around the blue, and when both numbers are going sideways over 80, until that red line closes back under 80, the game transitions itself where on pullbacks, the market often is finding good buying. If the red line closes under 80, then it sets up a test, more times than not, of the closest moving average, the key one, under the market. Now, I'll use several of them. I typically will use a 100, a 45, and a 18. In the case here, as you saw, I brought in a 200. I just wanted to see what the longer-term numbers looked like because they had a big importance back here when the market made that last peak. Remember what we were in the May, June, July periods? As we look at meal, different pattern. The market's got lower highs, lower lows. Now, when you get a real bull market in the soy complex, I've yet to see where the oil leads it, but that doesn't mean I'm right. I imagine it could, but more times than not, if the oil is up and the meal's down, it's a sign the market wants to stall a bit. And that's what we're getting right now. If you look at today's low, the market had a low of 301.10. That took out 301.80, so you've got lower highs, lower lows. Support's not far down. It's right here at the 18-day average, but should you close under 299.80, at that moment you would have lower highs, lower lows, and downside bias. What you have right now. While the swing line is down, the bias is up. And bias is so simple. It's either up or down 99% of the time. Sometimes the market will close right on that red line and then it's neutral. But more times than not, it's going to be either over or under that. And right now it's up, which counters the fact that the swing line turned down. In soybean oil, you can see momentum's been coming up. We're getting into an overbought area in the market. You're very close to the upper Bollinger Band at 30.37. Now, the reality is if you look at the fundamentals of soy oil, if there's an area that might be in a little short supply, it's one of those. However, I'm going to stick with what I know. More times the bull market comes when the meal leads the oil. I'm still looking for resistance if the market gets up there, but how long do you want to play that in front of the upcoming Chinese meeting and the WASDE report? Corn's having what we call a correction. It's got the pattern of lower highs, lower lows. In terms of the relation to the 18-day average, it's over it. So the bias is up, the swing line is down. They neutralize each other. When you take a look at what happened in the slow stochastic, you have a 78 reading. But if we go back, and we take a look. Friday, you had a 78 reading. Both numbers were not over 80. Both were over 80 on Thursday. Both were over 80 on Wednesday. And both were over 80 on Tuesday. So what happened is on Friday, the market lost that reading. In order to keep it lost, the day after it's lost, it cannot re-embed. It didn't. Therefore, I have a market where the odds favor, and that's all I can tell you, the odds favor price and the 18-day average coming together. Momentum has turned to the downside. The swing line is down, but the bias is up. No clear-cut uptrend anymore. In the wheat market, I see us caught between these black dashed lines right here and here. It's called the Bollinger Bands, and the market's gotten into a very narrow range. In the Chicago wheat, you still have the pattern of higher lows, higher highs. Even though you closed lower today, that's the pattern. The bias is up, but you have divergence since momentum is pointing down. When we get to the sugar market, let's go back to Friday. Here is a market still with the embedded reading. The market has a pattern after today of you broke through this low. I think you can see that. Once you took out 1259, two things happened. You had coming into today higher lows, higher highs. The 100-day average and the upper Bollinger Band met right up here. The market ran into very, very stiff resistance, and today you corrected when you got under that number. 1259 went right to what I call that line in the sand, the 18-day average of closes. You settled 1252 right over that number, and you've lost your upside momentum. So you can churn a bit right here. I wouldn't be surprised if we play around that 18-day average for a bit. In the coffee market, I'll stick with what I know. The first challenge, be it to the upside or downside of Bollinger Bands, is often an area where pros, especially if you're in sideways action, not a decline like you had right here. See that? If you're in sideways, that's often an area where the pros take some money off the table. Now, what do I mean by that? I am assuming that if the market's under the 18-day average of closes and headed down, that's a support zone. So I'm thinking the pros are short the market, and I'm thinking when you come up to these numbers, the pros are long the market. Can that be wrong? Of course it could be. But you need a starting spot. You need something to base other things on, and that's my assumption. Why? Because 95% of the time you'll trade within these black bands. And that means to me, I'm not the only one that knows that. The pros know it, and a lot of them build that into their algorithm or their mental way of trading. I'm not an algo trader. I'm a mental trader. In other words, I look at charts the old way. I use my eyes. I'm not relying on formulas to do the trade, and away you go. Algos are great if you have unlimited capital. That's what I've learned, because you're in and out of the market like so. Now, could they be longer-term algos? They can. I don't know of any, but they can. In the cocoa market, I look at this market right here on Friday's action. You had lost the embedded reading. We had lost it earlier, got it back, and when you lose it back to back, it's often a sign something's wrong, something's amiss. The highest high was made on this run on Friday. I'd look for first support if the embedded reading is lost at the 18-day average of closes. Secondary support, the 100. I didn't expect it to hit both numbers today, but it did. You stepped out of the uptrend, you're in a corrective mode. Now, when you lose an embedded reading, the market goes back, if you're bullish one, to being overbought, and it has to work that out. If the market was in a bearish embedded reading and loses it, it's oversold typically at that point. When we come over to the cotton market, you have upward momentum, upward bias. The market's in an uptrend, higher lows, higher highs. It's hit very important numbers 3 days ago. Got right up to the upper Bollinger Band, just missed the 100-day average, but it's hit an objective. We're going to see how this WASDE report on Thursday plays with this, but I wouldn't be surprised if pros do some evening up. Now in the cattle, this is called the embedded reading. You can see it crystal clear. And what it tells me is that on pullbacks, I would expect until the red line closes under 80 that the pros are buyers of the market. One of the numbers they might elect to buy is the 100-week average of closes, 100-day average, I'm sorry for saying weekly. 109 will round it to 109.37.5. Got it? The market trades 2.5-point increments. Somewhere between there and the 18-day average would be the support. The key is the embedded reading. Where's the resistance? Back up at the upper Bollinger Band around 112.87. Feeder cattle. The November lost its embedded reading. Warning sign, Will Rogers. You've got a pattern of lower highs, but the legacy has been higher lows. So until you take out 139.57, we're in a reactionary mode. It could, if it wants to break from here, and I would think a possibility is right here at the 18-day average to the 100. Remember, you've lost the embedded reading. That often means price and the closest moving average come together. In the hog market, let's not look at today yet. This is what the hog market looked like coming into today. We know that we're all looking for the Chinese to do something in pork that they've not done, buying it. And while the president said they're buying it, I don't see those numbers. I mean, I know that I looked when I came into the office today for confirmation that they're buying pork. I haven't seen it. Higher high, lower low. So the battleground seems to be the 18-day average on Thursday. If the market rallies from here, 18-day average is resistance. If it breaks, the lower Bollinger Band is a potential target. Momentum down, bias down, but not trending. Today you make your run, limit down, which is basically this lower Bollinger Band. You hit that. You couldn't go lower today, so I don't know if it's going to exceed that or not tomorrow. But as you can see, the market's certainly not acting like the Chinese are in this market to buy anything. We'll talk about this and a lot more in all that we offer our clients. Now, one of the things might be these technical trading tips from the pros that Modern Trader, through Futures Magazine, has put out. It's got Gantt Square, the benefits of relative strength, money flow index, rules for bottom fishers. I think the biggest rule for a bottom fisher is don't fish. Go with the trend. The trend's your friend. I'd rather buy the high of a day than buy the low. I know that sounds crazy to you, but it's true, because you want to be with the trend, and either way you're doing that doesn't seem right to me. Optimizing stops, it showed you what this all looks like. All you need to do is go to our website, and it says free offers. Click on it, you'll see the different offers we have, and yes, there'll be more coming up shortly. You can click up here if you'd like. That'll get you going right to that page if you're watching me on YouTube. I'm Ira Epstein. You have a good day, and I'll see you tomorrow.